Well, hey there, everyone. Dave Keller here with Market Misbehavior. I'm the president and chief strategist of Sierra Alpha Research, and thank you so much for joining me here on my weekly show on StockCharts TV. Today, we're going to talk about candle charts. This is an area of technical analysis that immediately resonated with me years ago as I was initially learning technical analysis. Candlestick charts just kind of clicked. I had the opportunity to meet up with Steve Nissen, who is really credited with introducing the West to a traditional Japanese form of charting called candlestick analysis. Really helped proliferate it here in the industry. And then over the years, spoke with people like Steve Bigelow and others who did a great job of promoting candlestick charting and its benefits. For me, it represents a visually rich way of analyzing short-term investor sentiment, short-term trading sentiment. And I found that combining that with conventional, traditional Western indicators like moving averages and RSI and other momentum indicators can give you a much more effective, representation of rotations between fear and greed from supply, demand, and so forth. So what we're going to do today is just look at some charts, look at some examples, talk about some of the key patterns, how we approach them, how we use them, how they relate to other lines and levels that we might see on the chart. And then I'll show you on the StockCharts platform how you can actually use the platform to scan for upcoming candle patterns, look for opportunities. Once you understand a pattern, you have a great resource on StockCharts to sort of continue identifying charts that look kind of in similar forms to ones that have been successful previously for you. All right, with that in mind, let's get to the chart. And what's funny is I kind of came up with the idea for the video as I was looking at the chart of AT&T. In my normal process of my work, I look at a ton of charts, probably thousands of charts a day, to be totally honest with you. I'm kind of all day looking at random charts for random reasons. My market recap show, by the way, called Chart This with Dave Keller, the main way I identify the charts that I'm going to talk about in every day's episode is I'm looking at charts for a lot of reasons, and I'll randomly take one and go, oh, that's a good one to talk about later, and I'll pop it on a chart list, and by the end of the day, I've got a pretty good list of charts to sort of review with all of you if you watch the show. So with that in mind, the chart of AT&T, as I'm looking across, I'm like, boy, this just has a lot of great examples of candle patterns that I think would be helpful to review. So what we're going to do is just spend a lot of our time just going through some of the candle patterns that I see on this chart. And I have some other examples of more sort of idealized candle patterns, right? Charts where it's been a pivotal turning point and it's been really helpful. As we go on, one thing I will tell you, looking at the chart of AT&T, with candlestick charting, it really, generally speaking, although there are some continuation patterns that are meant to help you understand a trend is continuing, I already have a bunch of tools in my own toolkit that are all trend following tools, right? When I'm looking at moving averages, looking at my market trend model, which is all based on moving averages, of course, when I look at, a lot of sort of, trend following tools, I kind of already have a pretty well-defined toolkit that helps me identify when stocks are in uptrends and stocks are in downtrends. I don't really need another reason to sort of validate that. But what I'm always looking for are initial signs that trend may be in question, right? That there may be a potential reversal. And I think that's the real value with candlestick charting. They tend to be shorter term signals. So when you see a candle pattern on a daily chart, it's telling you about like the next 1 to 3 days at most. That's really all it's trying to tell you about. But it's good at telling you sort of short-term mean reversion signals. And I found for me that tactical color, understanding when the market may have a short-term kind of tactical move higher or lower, really helps me think about the context of the longer-term trends. Maybe be a little more thoughtful about when I'm adding to a position or when I'm unwinding part of a position based on candle patterns that may emerge. All right, enough of an intro. So looking at the chart of AT&T, what we're going to do is kind of start at the high level, and I'm just going to start zooming in and zooming out. We're going to start with, I think, two of the most commonly found candles, ones that I often get questions on that I think are just fantastic to note. And these are what we call a hammer candle and a shooting star candle. A hammer candle, if you look at the chart of AT&T, a pretty good example of that is here in kind of mid-March. Let's zoom in a bit and you can see what I mean. I'll try to not make it too blurry, but this is the candle that we're talking about. So what you have to remember, a couple things, right? With candle patterns, the trend matters, right? So if we're in a downtrend and a pattern appears, or we're in an uptrend and the pattern appears, the conclusion could actually be very, very different, right? So a certain candle that pops up in a downtrend could be quite bullish, but the same candle that happens in an uptrend would be bearish, right? Because it's a reversal signal. So first off, one of the things that Steve Nissen taught me early on when I met with him years ago in my Bloomberg days was, first, before you think about the particular candle pattern and what it might mean, focus on the trend. What is the trend leading into that pattern? So we'll start off by saying this hammer candle, it has to happen in a downtrend, right? If it's an uptrend, it's not a hammer candle. It actually has a different name called a hanging man. For another video, we'll dig into that one. But a hammer candle, pretty classic bottoming signal, right? So it happens in a downtrend. You have this hammer candle that pops up. I always tell people, think of it as you're hammering out a bottom, right? We're in a downtrend. You have like the nail in the coffin of the downtrend, the big hammer, and then we bounce back up. Think about what this particular one candle pattern represents. We're in a downtrend, right? So sellers are in control, essentially. We have an open, which is here. We have a low way down here. We have a little bit of an upper shadow. Ideally, there's very little upper shadow. This one's a little one. I'll give it some room. I think you need a little bit of flexibility with these patterns. But overall, ideally, there's a long lower shadow and little to no upper shadow. And then the open and close are near the upper end of the range, right? So you have a big downtrend. We open. At some point, we've traded a lot lower, but by the close, we've gotten all the way back up to eclipse the day's opening price. And so think of it as sort of a V-shaped day, although it could have been a very different shape. But generally speaking, think of it as like a V-shape, right? We're coming down, we hit the low, we trade higher, and by the close, traders are more optimistic. There's some accumulation happening during the trading day because we're closing near the upper end of the range. So when you see that candle pop up in a downtrend, it's a short-term reversal candle telling you we're probably going to see the next 1 to 3 days higher. As you can see, we certainly did 3 straight up closes, and it was the beginning of a nice bounce, which ended up going into a high in early April. So that's the first pattern I'm sharing with you, the candle pattern. You flip that pattern over, and you see a long upper shadow, little to no lower shadow, and the open and close near the lower end of the range. And again, that happens in an uptrend. So it's what we just talked about, but everything's flipped over. That's called a shooting star candle, right? Kind of looks, if visually, a lot of the Japanese techniques, the names really are, representing the visual, face here. So the kind of looks like a shooting star. The hammer candle kind of looks like a hammer. The shooting star kind of looks like a shooting star with the open and close near the lower end of the range. Long upper shadow, little to no lower shadow. When that happens in an uptrend, it's telling you the opposite, right? It's telling you we initially rallied during the day, but by the close, we got back down toward the lows. And to be honest with you, whether the open or close are slightly higher, it doesn't matter. Right? It doesn't matter if it's a solid candle or an open candle. As long as the open and close are close together and near the lower end of the range, that's called a shooting star candle. That's telling you bearish for the next 3 bars. So again, even if you're a long-term trend follower, if you're more of a position trader like me, these candle patterns may feel too short-term, right? Like they're too, just telling about the next day or two. You don't really need that. But I will tell you that what it does is it helps you respect that tactical time frame, that short-term time frame, and understand how the trends you're following may start to evolve. So if you think the chart's in a brilliant uptrend and you're kind of lights out, all in, riding this chart long and strong, and the shooting star candle pops up, it may be a fantastic red flag to say, hold on a second, maybe this trend is going to take at least a major pause. And it certainly did, right? We pulled back to the 50-day moving average before resuming the uptrend into another shooting star candle, as we see a little bit further on. So those 2 candle patterns on their own, I think, really valuable to watch. The hammer candle at a potential low, shooting star candle at a potential high. Just very, very helpful at illustrating a potential reversal in sentiment from bearish to bullish or bullish to bearish with those two examples. Another one I want to show for you is called, this one doesn't have everything, but it does have some pretty decent examples. We're going to look at this one next. This one is called a morning star candle, right? So same thing. It has to happen in a downtrend. You have a big down day, you have a little day, and then you have a big up day, right? So think of it as like a big down day and then a big up day and a kind of a little day at the lower end of the range stuck there in the middle. It's a 3 candle pattern, big down day, a small bar, a small candle, and then a big up day. It's called a morning star candle, right? Think of it as we're in a downtrend, we're hitting pause, we're now in an uptrend. That's what that 3-bar pattern tells you, right? A day of distribution, a day of indecision, a day of accumulation. Those are the 3 days that make up that pattern. So again, if we see a downtrend as we observe here, and then you see that 3-candle pattern, that tells you the next 1 to 3 bars more likely higher. You can see the opposite here is what we would call an evening star pattern, an up day, an indecision day, and a distribution day, right? So an up day, sort of a choppy sideways day, and then a big down day. So a 3-candle pattern that happens in an uptrend called an evening star pattern. We're going up, we're undecided, we're going down. So that 3-candle pattern basically tells you whatever that trend was, that bullish trend going into that pattern, most likely has now reversed into a downtrend phase. So you see how here, and just to zoom out a bit, we're at this point in May, we've retested the previous high. We have these shooting star candles that really speak to the importance of this resistance level. This is clearly a valid resistance level. It ended up being tested a number of times in subsequent months. But then we have a rotation lower. As we test the 50-day moving average, we have this morning star candle, which tells you, okay, probably this pullback is over. Probably want to be playing more the long side, betting on a reversal to the upside, which certainly played out. If we follow along here, finally, we have a pretty good uptrend. We're making new highs, but then we have the evening star candle pattern. So what it tells you is, all right, that uptrend phase most likely done. Maybe we want to play more the short side or be a little more cautious because there's probably a bit of a pullback sort of happening. Another thing to keep in mind, and I apologize, this is a bit of a stream of consciousness style episode as I'm just unloading random things I've picked up over the years working with some legendary candlestick charting experts, traveling to Japan a number of times and talking with candlestick chartists there. And just working with a lot of traders on a lot of desks that use candle charting primarily. So I hope this is helpful, just kind of running through some thoughts. One thing that Steve Nissen taught me a long time ago was don't forget to use the candle patterns themselves for risk management. So if you have a hammer candle like this, let's say you buy the chart at the close because you see the hammer candle going into the close, you're like, yep, that's a hammer candle. I probably want to be, thinking more upside from here, so I buy going into the close, betting on the next couple days to be up. Well, how do you know if you're wrong, right? What do you use? Well, you can use traditional, stop loss techniques like a percentage stop or something like that. But candle charts really have built-in risk assessments, right? And so anytime you have a candle pattern, you use the low of a reversal candle in a downtrend, or use the highs of a reversal candle in an uptrend as your stop. So the idea here is, a potential way to play this. You buy going into the close because of the hammer candle. You use the low of that day as a stop. So you're basically playing the long side, but if we break below that day's low, which would be the low of the candle pattern, you're out. Same thing here. Maybe you sell or you're short on the candle pattern, which looks like a shooting star, but you look at that high and that's your immediate level of risk. So you're playing potential downside, but if you got your the other way kind of limited, your risk clearly defined because of that shooting star candle. Same idea with these 3 candle patterns, right? So with a what's called a morning star candle, use that the low of the pattern as a stop. Same thing with an evening star candle. You use the high of that 3 candle pattern as a stop. So candle patterns are actually really helpful in that they give you a sense of short-term reversals, but also have built-in stops, really, if you think about it. Because what that means, right, is if we would blow right above that day's high, what that would tell you is, that evening star candle just didn't work, and so we want to get out of the way and reassess, right, and look for a new candle pattern maybe to emerge. So those are some of the candle patterns. There are other ones on here, like a bullish piercing line, if you want to get technical, a bullish Harami. There are literally hundreds of different candle patterns. This is a dark cloud cover pattern that you see. The more you learn them, the more that you will see them pop up a lot. And I will show you at the end, there's a great resource, a free resource on StockCharts as part of their ChartSchool, where they actually have illustrated examples of all of those chart patterns I just mentioned and a bunch of other ones as well. Let's look at a couple more examples and then we'll call it a show. Here's a classic pattern called the Bullish Engulfing pattern. And I wanted to point this out here because this is at the April low. This is Apple, actually. We sold off. The market actually bottomed out on April 7th. Apple actually made a new low on April 8th, actually undercut that day. But then the next day, right, so you have a big down day and then a big up day. The second day, the up day engulfs the down day. And we're talking about the real body here, the distance from open to close, which is like the body of the candle, right? So the body of the candle tells you the open and closing levels. The vertical line, which is called the stem, actually tells you the intraday high and low. So same as a bar chart, that vertical line tells you the range of the day, the trading range. The body here tells you the open and the close. And a down day is a solid day. That's a down close. So we open at the top and close at the bottom. A clear or an open candle is an up day. So we open at the bottom of the body and we close up at the top of the body. So this is a big down day in a downtrend. We have another big down day making a new swing low, then a lower open and a higher close. That's called a bullish engulfing pattern. It happened here before this nice bounce higher and ended up being the low for 2025 so far. For the chart of Apple. Reason why I want to point that out there is because there are a bunch of stocks that had similar, very bullish candle patterns. And so I've found using candlestick analysis as more of a breadth indicator, right? Do I see a bunch of bearish engulfing patterns on a bunch of leading growth stocks? Maybe that tells me that this downtrend phase in March and April is probably right around its ending point. And so those big up days from a candlestick perspective, really told the story of a market rotating from a period of distribution to a period of accumulation. So something to keep in mind that if you see a bunch of candle patterns in a bunch of similar names, maybe that tells you that there's a shift happening in the market. Certainly that is how I would describe early April in 2025. Also want to mention, of course, with a couple random examples here, this is the S&P 500, the SPY. I'm using the sector spider. I just want to highlight this particular example. We talked about this pattern on the chart of AT&T. This is actually an evening star pattern. Remember, that's an up day, kind of an indecision day, and a down day. This is technically, if you really want to get specific, you call this an evening Doji star because the middle day is a Doji candle, kind of a cross where the open and close are almost identical, as opposed to a regular evening star where it could be a little body there. It has to be a small day, but it could be a little body. But if it's a cross like this, which is called a Doji candle, this is technically called an evening Doji star. So if you're studying for your CMT exams later this year, remember that one. That one can pop up randomly. But the reason why I wanted to point this out on the chart of the S&P is because this was like mid-March. We'd had a big downtrend. Look at all these lower lows, lower lows. Finally, we bounce higher. We push back above the 200-day. And I remember this period. We'd undercut the 200-day. We started to pop above. And I remember thinking, ooh, if we get back above the 200-day and can hold that, maybe this wasn't that bad of a sell-off. Maybe we're going to recover from there. Of course we didn't, right? We ended up accelerating into early April and making the eventual market low. But this pattern, as we attempted to get back above the 200-day, was one of those things looking back that was a great signal that it was a short-term rally, probably reversing lower for another big move down because we had the bounce higher. We get above the 200-day, up day, indecision day, down day. That's an evening star pattern which undercuts the 200-day. So that's an indication that we are probably not regaining the 200-day. We're not going to get a foothold above there. We're getting back below, and that means we need to be more thinking defensively as we rotate lower. So context matters. Where these candle patterns happen relative to previous support and resistance levels, relative to moving averages, relative to overbought and oversold conditions using indicators like RSI. I think if you just use candle patterns in a vacuum and don't leverage other Western technical indicators, you're missing one of the great collaborations between different unique but very powerful parts of the technical toolkit. So context matters. Make sure when you look at candle patterns, think about what it means with where the price is relative to key moving averages, key support and resistance levels. Don't neglect the rest of the technical toolkit, I guess, is my PSA right about there. So let me tell you a little bit more about the candlestick charting features on the StockCharts platform. I think they do candle charting really well, particularly your ability to scan for these patterns. I think it's a fantastic opportunity. Once you learn, and I will tell you this is the way you learn it, by the way. Once you've figured out a pattern like a hammer pattern or a hammer candle or a bullish engulfing pattern or something like that, use the scanning engine on a platform like StockCharts to just look up examples and then look at the chart, see what it's telling you. Look back in history and look for example of these patterns and see how would I have traded it? Where would I have gotten in? Where would I have put a stop? That's how you sort of prepare for the next time when you see it tomorrow or the next day on live charts that you're trying to trade. So on StockCharts, if you go to Charts and Tools, you'll find this section. Is that at predefined scans? I don't think so. I think it's predefined. No, I think it is predefined scans. Yeah, predefined scans. Here we go. We get to this page right here. And this shows you a bunch of different technical indicator-based scans that are pre-programmed. The idea here is you can run the scan from this page. If you like it, you can save it to your own login and then edit it, right, and customize it a little bit further, make it more meaningful for you. But as a starting point, this gives you a lot of really good examples of commonly scanned tools and techniques. Might give you some opportunities to stretch your thinking a little bit. The way this works is in the left column. It tells you the number of stocks whenever you run the scan, and it's using intraday data. It'll tell you how many are hitting these different criteria. And then on the right, it's showing you by exchange. So I usually start with the New York Stock Exchange because that's a pretty good list of stocks. Gives you some great examples to work with. But if you focus on another market, feel free to use those as well. And if you scan down just a little bit on the page, there's this section called Candlestick Patterns. You could see some familiar things because we just talked about bullish engulfing patterns, morning star patterns, piercing the bullish piercing line. These are all different candles, hammer candles, shooting stars. These are all sort of on here. And as a reminder, all you do is you click on the number and it'll show you the tickers. You can click on the chart to get in a little bit further. I ran the scan of bullish engulfing patterns a few moments ago, just before we started. Just to give an idea, 49 stocks or charts on the New York Stock Exchange. This does include things like ETFs that are listed on the New York Stock Exchange, so you know. But again, if you want to tweak it, you can click on Edit Scan Criteria, eliminate the ETFs, just look at members of the S&P 500, whatever's going to make it more meaningful to you. But I grabbed one of these, the insurance ETF, KIE, actually came up with a bullish engulfing pattern. This is why I find this sort of scanning tool so valuable. You know, today, and again, the market's not closed. We're at 11:30 a.m. Pacific time, so 2:30 p.m. Eastern time. Still got an hour and a half left of trading. But this is currently a bullish engulfing pattern, right? We're in a downtrend. We have a down day, and that's on Friday. We have a lower open, and for now, a higher close. Look at where we're at relative to that 200-day moving average. We have a bullish engulfing pattern as we have just broken the 200-day on Thursday and Friday. This bullish engulfing pattern would imply maybe a short-term bounce from here. Maybe we regain the 200-day moving average. Insurance companies have been struggling so far in the month of July. Maybe this is a good sign of an upside reversal as we get into earnings season this week with a lot of financial stocks reporting. Keep in mind, though, when you run this sort of scan on stock charts, it is using live data. So if you run a scan during the trading day and then you run the same scan an hour later, the results may be different because the patterns are changing, right? In a volatile market, it could look like a bullish engulfing pattern, but if the market, if insurance stocks would sell off for the next hour and kind of get back down to here, it's no longer a bullish engulfing pattern. So anytime the chart, the bar you're looking at is highlighted in green or in yellow, that means on stock charts, it's an open market. It's an active market. So the candlestick is not sort of etched in stone just yet. If you bring up the chart and it's no longer shaded in green or in yellow, that means the market's now closed, and you can confirm that candle pattern is valid. So be a little wary of candle patterns during an open market because they can change, right? This daily candle can evolve quite a bit if the market is it gets into a volatile period, particularly in the last hour of trading when you have a lot of institutional volume. But potential good short-term reversal signal brewing there for insurance stocks. Now, if I lost you with some of these candle patterns, if you can't tell a Harami from a hammer and you need help, the Chart School on Stock Charts is a free resource that is absolutely fantastic. And I will tell you, when I was studying for the CMT exams a couple years ago, I read the John Murphy book on candle, and his main book, Technical Analysis of the Financial Markets, has a great chapter on candle patterns. I reviewed that a ton. I then went to Steve Nissen's books on candle charting, all of which I think are pretty well done, and I looked at a lot of examples there. I went to the Chart School pages on stock charts, which were an earlier version of what you're seeing here, but they're awesome, and they have a lot of great illustrated examples, really help to reinforce it. Then I just started looking at a bunch of charts, and I wrote down candle patterns I saw. I circled them on the chart. I'd print them out and circle them and make notes, and just looking at live markets and just looking for some of those key patterns really helped me. So make sure you take advantage of the scanning tools on stock charts, but also the Chart School. And you can find that at the top of the Stock Charts website. If you go here, you'll find the link to Chart School, and then just search for candle patterns. There's a whole section on candlestick charts, how they're built, different key patterns to look at, and a lot of great examples illustrated right in that free portion of the website. That'll do it for today. By the way, if you want to see how we apply candlestick analysis real time every trading day, check out my market recap show called Chart This with Dave Keller. You can find that on my YouTube channel called Market Misbehavior. We run it every weekday after the close at 5 p.m. Eastern, 2 p.m. Pacific. You can join the live stream if you like. If you can't make it live, no worries. Just watch the replay on our YouTube channel. It's pretty good too, I hope. And if you have questions, the whole point of that show is to generate questions as you're watching the live stream. You can ask questions during the show. If you're watching it later, just put a comment below the YouTube video. I read every question that comes in personally, and I appreciate your questions as you're trying to navigate these markets. Also, don't forget about the Market Misbehavior podcast. I'm having a ton of fun. We're almost 60 episodes in to the new podcast that I launched last fall. I've had some really good interviews with some top market practitioners. Just in the last week, I interviewed Victor Hagani, who is one of the founding partners of Long-Term Capital Management. You may have read books about that whole episode in market history in the late 90s when the hedge fund colossally imploded. It was fueled with some really knowledgeable investors, Nobel Prize-winning economists, and it was a fantastic cautionary tale in challenges of modeling market activity. I had a great interview with Victor, who's written a fantastic book called The Missing Billionaires about his experiences at LTCM, but also his experiences after. He was really helping to educate investors, particularly on bet sizing. Also, Adrian Zadunchik, who is a cryptocurrency expert, interviewed him end of last week. That episode just posted here on Monday, July 14th. Check that out as well. Some great thoughts about seasonality for cryptocurrencies, how to think about Bitcoin dominance as it's making new all-time highs over the weekend, and much more. Thanks so much for joining me here on Stock Charts TV. I wish you a fantastic week. We'll be back next week. In the meantime, remember, it's always a good time to own good charts.